Have you ever wondered how to secure your financial future or enhance your investment plans? In the world of finance, there's a secret weapon that many successful investors use to grow their wealth over time. This secret weapon is known as investing, and it has the power to transform your financial future. But why is investing so important? The answer lies in a concept known as compounding. Compounding is the process where the earnings or interest from your investment are reinvested, generating even more earnings over time. It's a bit like a snowball rolling down a hill, growing larger and faster as it picks up more snow. In the world of finance, your investment is the snowball, and the snow it's picking up represents the earnings from your investment. Now let's break down this concept a little further. Imagine you invest $100 into a savings account that offers a 5% annual interest rate. After 1 year, you'll have $105. If you leave that money in the account, the interest for the second year will be calculated on the new total of $105, not just the original 100. So by the end of the second year, you'll have $110.25, and so on. This is the power of compounding. However, compounding doesn't just apply to savings accounts. It's a fundamental concept in all types of investing, from stocks and bonds to real estate and mutual funds. The key is to reinvest the earnings or interest from your investment rather than taking them out. This allows your investment to grow exponentially over time, not just linearly. So why is understanding compounding so critical? Because it can be a game changer for your financial future. With the power of compounding, even small investments can grow into substantial sums over time. It's like planting a seed and nurturing it over time to grow into a towering tree. In conclusion, investing is an essential tool for securing your financial future, and understanding the power of compounding can significantly enhance your investment strategy. Understanding and utilizing compounding can be a game changer for your financial future. Now you might be asking, what are compounding assets? Well, just as the name suggests, compounding assets are those investments that generate earnings, which in turn are reinvested to produce their own earnings. Picture it as a snowball rolling down a hill, gathering more and more snow as it goes. The snowball, in this case, represents your initial investment, and the snow it picks up along the way stands for the earnings or returns that it generates. Now here's where the magic happens. The additional snow that the snowball picks up also starts picking up more snow. This is analogous to the earnings from your investment, generating their own earnings. This process, my friends, is what we call compounding, and it's an incredibly powerful tool in the world of investing. Compounding assets can include a wide variety of investments, such as stocks, real estate, or even a simple savings account. What makes these assets compound is not necessarily their nature, but rather the way you handle the earnings they generate. By reinvesting those earnings back into the asset, you're setting the stage for compounding to take place. The potential long-term benefits of compounding assets are quite remarkable. It's not just about making money on your money, but also about making money on the money that your money makes. This might seem like a mouthful, but it's this reinvestment of earnings that allows your investment to grow at a faster rate than it would if you simply pocketed the proceeds. Think of it as an investment growth engine. Once you kickstart it, it keeps running and accelerating, provided you keep fueling it by reinvesting the earnings. It's important to note that while the potential for growth is significant, compounding assets should be part of a balanced and diversified investment strategy. Like all investments, compounding assets come with their own set of risks and rewards, and it's crucial to understand these before diving in. The magic of compounding assets is that they can grow exponentially over time, not just linearly. It's a powerful strategy that can significantly enhance your financial future. So why not start exploring the world of compounding assets today? Are you curious about the types of compounding assets you can invest in? Let's dive in and explore some examples. First up, we have stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of the company and its future earnings. If the company does well, you can earn dividends which can be reinvested to buy more stocks. This is a perfect example of compounding. Your earnings generate more earnings. Next, we have bonds. Bonds are essentially loans you give to a company or government entity. In return, you receive interest payments. These interest payments can be reinvested to buy more bonds, creating another layer of compounding. Then there's real estate. Real estate investments can generate income through rent. This rent can be used to purchase more properties, creating a snowball effect. Not to mention, the value of the property itself can appreciate over time, adding another dimension to your potential earnings. Mutual funds are another great example of compounding assets. A mutual fund is a pool of funds collected from many investors, used to buy a diversified portfolio of stocks, bonds, or other assets. The earnings from these investments can be reinvested back into the fund, creating more wealth for the investors. Let's not forget about exchange-traded funds or ETFs. These are similar to mutual funds but trade like stocks on an exchange. They offer the same compounding benefits as mutual funds but with added flexibility. There's also the option of reinvesting earnings from your business. If you own a business, you can reinvest the profits back into it to fuel growth. This can lead to higher profits in the future, another form of compounding. And last but certainly not least, there's your own human capital. By investing in your education or skills, you can increase your earning potential. These increased earnings can then be reinvested to further boost your wealth. These are just a few examples of compounding assets, but the possibilities are vast. Whatever path you choose, remember, the magic of compounding works best when given time. So, start early and watch your wealth grow. So, when is the best time to start investing in these compounding assets? Well, let's tackle that question with a simple but powerful truth. The best time to start investing in compounding assets is as early as possible. You see, the magic of compounding is that it can significantly enhance the growth of an investment over time. Imagine this scenario. Let's say you have two friends, Jack and Jill. At age 25, Jack begins investing $100 a month into a compounding asset with an average annual return of 7%. Jill, on the other hand, waits until she's 35 to start making the same monthly investment. Fast forward to when they're both 65. Even though Jill invested the same amount per month as Jack and they both earned the same rate of return, Jack's investment will have grown to more than double that of Jill's. Why? Because Jack gave his money more time to grow. He took advantage of the power of compounding. Now this is a simplified example, of course. The actual growth of an investment can be influenced by a variety of factors, including market conditions and investment choices. But it illustrates the point. Time is an investor's best friend. But what if you're not in your 20s or 30s anymore? Is it too late for you to start investing? Absolutely not. While it's true that starting early gives your money more time to compound and grow, it's never too late to start. The important thing is to start now, regardless of your age. Even if you're in your 40s, 50s, or beyond, you can still benefit from the power of compounding. So here's the bottom line. The sooner you start investing in compounding assets, the more time your money has to grow. And the more your money grows, the closer you get to achieving your financial goals. The sooner you start investing in compounding assets, the longer your money has to grow. Before we wrap up, let's summarize the key points about investing in compounding assets. Investing, as we've discussed, is much more than just a means to amass wealth. It's a strategic tool that allows us to leverage the world's economic activities to secure our financial future. And among the various investing methods, compounding assets stand out as a remarkable and reliable strategy. The beauty of compounding assets lies in their ability to generate earnings that are then reinvested to create even more earnings. It's a snowball effect where your investment grows exponentially over time, not linearly. This is the power of compounding, a principle that has been aptly termed the eighth wonder of the world by some financial aficionados. We've also delved into the different types of compounding assets. From stocks that pay dividends to real estate investments, bonds, and even certain types of savings accounts. Each of these assets has its unique features and benefits, but they all share the common thread of offering compounding returns. Diversifying your investments across these different types of compounding assets can help spread risk and increase the potential for higher returns. But the real magic of compounding assets unfolds when you start investing early. The longer your money is invested, the more time it has to compound and grow. Each day, month, or year that you delay can potentially translate into missed opportunities for growth. So, whether you're in your 20s or your 60s, now is the best time to start investing in compounding assets. But remember, investing is not a get-rich-quick scheme. It requires patience, discipline, and a well-thought-out strategy. Make informed decisions, take calculated risks, and above all, stay committed to your financial goals. Remember, investing in compounding assets can be a powerful tool for securing your financial future. It's never too early or too late to start.